Something broke in the silver market last night. When Asia opened, silver did not move step by step. It jumped, leaving a blank space on the chart like a missing heartbeat. The usual sellers were gone, the price gapped up, and the data now shows big players on the wrong side of the trade, losing money every single cent this climbs. We have seen this pattern before, just before major squeezes and historic cracks in the system, but this time the pressure is bigger, the debt is higher, and the room to hide is smaller. If this gap holds, it could be the moment the paper game starts to lose control over real metal, and that has serious meaning for anyone who saves in dollars, stocks, or bonds. Stay with me, because in this video I'll walk you through the signals, the hidden risks for the banks, and what this move could mean for your own money. If you want more clear, no-noise breakdowns like this, make sure you subscribe, hit the like button to support the channel, and watch this story right to the end. The clues. Around "it happened," silver just gapped up, the squeezes on are far too important to ignore. Silver did not trade its way higher. It jumped. When markets opened, the price was sitting several percent above the last closed, with almost no trades recorded in between. On a price chart, that empty space is called a gap. In a deep global market like silver, big gaps without a clear news shock are rare, and they almost always point to stress below the surface. During the move, the order books on several major exchanges looked thin. Quotes flickered, spreads widened, and small buy orders were able to lift the price through levels that usually take heavy volume. It was like watching a bridge with missing support beams. Even light traffic can suddenly strain the whole structure. That missing liquidity is the first irregularity. Historically, important silver moves have often begun with strange, low liquidity jumps. In late 1979, before the Hunt brothers squeeze became front-page news, silver started to gap over previous highs as sellers stepped back. In early 2011, before the final surge to almost 50, night sessions also showed sharp gaps, hinting that normal trading was losing control of the price. The puzzle now is simple but serious. Who pulled their offers this time, and why? Were shorts quietly stepping aside? Unwilling to take the other side? Did a large, urgent buyer enter the market when most players were asleep? Or did risk systems at banks and funds automatically cut exposure after weeks of building pressure? This gap is more than a chart pattern. It is a signal that the usual balance between buyers and sellers just broke. And once that balance snaps, the path toward a full squeeze becomes much easier to follow. For now, the gap stands there like taped off ground at a crime scene telling us something happened, but not yet who is responsible. The price gap did more than surprise traders. It locked many of them into bad positions. A large group had bet on lower silver prices. These are the shorts. They make money if silver falls and lose if it rises. When the market gapped up, many of these short positions were suddenly deep in the red before they could react. Most of these bets were placed with borrowed money using leverage. Brokers lend funds against margin. When prices move fast, margin rules can turn from a safety belt into a noose. As silver jumped, risk systems at banks and brokers started to mark short positions to the new higher price. For some traders, that meant instant margin calls. Either add cash or close the trade. Here is where a squeeze begins. A trapped short can only escape by buying back the same silver they had sold earlier. Many shorts trying to buy at once is like a crowd trying to push through a narrow door. Each urgent order drives the price higher, which creates more losses for those still short and even more forced buying. It is a chain reaction, like one domino falling onto the next. Recent trading data showed a sharp rise in call option volume on silver just before and during the gap, while put activity faded. That shift in options flow is an irregular signal. It hints that either insiders expected a jump or retail traders rushed in after seeing the first spike. History shows the same pattern. GameStop in 2001, Volkswagen in 2008, and silver in 1979 all saw shorts squeezed as price jumps collided with high leverage. The open question now is simple. How many shorts are still stuck, and how much more forced buying lies ahead? The silver gap we just saw is not new in history. It looks like an old pattern coming back to life. In 1979, when the Hunt brothers tried to corner silver, the price did not rise in a smooth line. It jumped in sudden steps, leaving gaps on the chart as sellers pulled back and fear took over. Each jump that was a sign that normal trading was breaking down. Again, in 2011, when silver climbed close to $50, the same kind of behavior appeared. Thin overnight trading, sharp moves, and prices leaping over old levels without real pauses. That surge ended in a brutal crash, but the early stages looked very much like what we are seeing now. Strange gaps, rising tension, and a sense that someone, somewhere, was scrambling for cover. The current market shows a similar rhythm, fast spikes, shallow pullbacks, and then another push higher. But that repeating pattern is a warning. It suggests forced buying, not calm investing. It is like watching a car being pushed uphill by people who are already out of breath. You know they cannot stop, or the vehicle will roll back on top of them. One irregular sign today is the mix of futures and options positions. Data from major exchanges shows large commercial players still holding big short positions, even as smaller traders and some funds are turning more bullish. That split mirrors the tension of past squeezes, when strong hands thought they could ride out the storm right up until they could not. The open question is how far this echo goes. Are we seeing only a brief replay of old drama, or the first act of a full squeeze like 1979 and 2011? The answer matters because, just as in those earlier episodes, strange price gaps can be early clues to much deeper stress in the system. Paper silver is not metal you can hold. It is contracts, futures, options, and fund shares that promise silver later. Physical silver is bars and coins that must be mined, refined, shipped, and stored. Most trading today happens in paper, not in real metal. That is normal, but it also creates a weak point when prices jump fast. During this latest gap up, most of the move first appeared in the futures market. Screens lit up, contracts traded at higher and higher prices, yet many dealers in physical silver were still using old quotes for hours. Then the catch-up began. Coin shops and online dealers started to raise prices, not just by the same amount as futures, but even more. Premiums over spot widened, sometimes by double digits. That spread between paper prices and real-world prices is a red flag. It tells us that demand for metal in hand is stronger than the price on the screen suggests. And we saw this before. In 1980, near the end of the Hunt brothers story, some dealers refused to sell at quoted prices because they feared not being able to replace stock. In 2020, during the first pandemic shock, physical silver dried up for weeks, even while futures were still trading normally. Today, reports from major warehouses show declining registered stocks, the portion of silver officially available for delivery. At the same time, open interest in futures remains large. That is like a game of musical chairs with too many players and not enough seats. The unanswered question is simple. If more traders suddenly ask for delivery instead of cash, will the paper system bend, or will it finally break? This gap, and the growing split between paper and physical, suggests that pressure is building again in the same fragile spot. For years, central banks tried to control markets with low rates and easy money. That cheap money pushed investors into risk and away from safe assets. Now, with inflation sticky and rates higher, that old playbook is failing, and silver is reacting. The gap up is not just a metal story, it is a sign of stress in the money system itself. When inflation rises and trust in paper money weakens, hard assets return to focus. History shows this clearly. In the 1970s, after years of rising prices and policy mistakes, both gold and silver exploded higher. Central banks kept talking about control, yet real-life costs told a different story. Today, food, rent, and energy are again rising faster than many official targets. Even as headlines claim inflation is cooling, that mismatch is a quiet red flag. Banks and big funds also use silver as collateral, a kind of pledge, to back loans and trades. When volatility jumps, the same ounce of silver can no longer support as much borrowing. Risk models demand more margin, just as they did during the 2008 crisis and the 2020 pandemic shock. It's like a building where support pillars suddenly shrink. Everyone on the upper floors feels less safe at once. An odd detail in recent data is that some central banks are adding gold while staying silent on silver, even as industrial demand for silver grows. If they fear currency risk, why ignore a key monetary metal that is also vital for energy and tech? That silence is another irregular piece of the puzzle. The open question now is whether this silver move is an early vote against current policy, a signal that faith in central planning is slipping faster than officials admit. Once confidence cracks, gaps like the one we just saw can become far more common. Most people picture traders shouting on a floor. Today, most silver trades are triggered by lines of code. When the gap up appeared, it was not only human fear that moved, but machines. High-frequency programs scan prices thousands of times a second. They are trained to jump on sudden moves, to chase momentum, or to pull their quotes if risk looks too high. That instant reaction can turn a sharp move into a vertical spike. Many funds also use volatility targeting. Their models watch how wild prices are. When prices swing harder, the models often cut position size. In a jump like this, that means some funds are forced sellers of other assets, while trend-following systems may become new buyers of silver, simply because the chart now shows a strong breakout. It is like a microphone too close to a speaker. A small sound turns into a loud, painful loop. History shows how dangerous these loops can be. In the 2010 flash crash, stocks briefly fell almost 10% in minutes as algorithms sold into each other's orders. In 2018's Volmageddon, volatility products blew up when models all tried to adjust at once. The underlying news was not new. The structure of trading turned a normal shock into something far more violent. Early data around the silver move shows a spike in ultra-short-term volume and quote cancellations right after the gap. Orders appeared and vanished in milliseconds, a sign that machines were probing, then stepping back. That irregular behavior hints that even the algorithms were unsure how to price this jump. The open question is unsettling. Are these systems now locked into a pattern that will keep amplifying every uptick? Or will they suddenly switch off and leave a thin market hanging in midair? Just as earlier signals suggested, the squeeze may now be running on automatic. The silver gap is no longer just a chart event, it is a message. Put together, the signs we have followed are trapped shorts, thin liquidity, rising physical premiums, nervous algorithms, and confused policy signals tell one simple story. Confidence is weakening at the edges of the system. Silver has always behaved like a stress gauge. In 1979-80, it screamed higher as faith in money and politics fell, then crashed once extreme measures hit. In 2011, it jumped during the fallout from the global financial crisis and the Eurozone panic. Each time, a violent move in silver was not the main crisis, but a flare in the sky, warning that something deeper was out of balance. The irregular pieces this time are harder to ignore. Major gap with no clear news, futures that run ahead of physical markets, large short positions still unclosed, and central banks that talk about stability while real-world prices keep rising. It feels like watching hairline cracks spread across a wall that was painted over too quickly. So the open question now reaches far beyond metals. Is this squeeze a brief storm created by leverage and machines? Or is it the first signal that people no longer trust promises? As much as they trust things they can hold, and if more investors start to treat silver not as a trade, but as escape from paper risk, then this move stops being a spike and becomes a trend. Just as the earlier signals hinted, the gap may be telling us that the next phase of instability will not start in banks or bonds, but in the places where finance meets the real world, in energy and commodities, and in the quiet corners of the market where stress can build unseen until it suddenly explodes into view. The evidence now lines up like a clear set of fingerprints. It began with a gap that should not appear in a major global metal. Price jumping over empty space, order books thin, liquidity missing when it was needed most. Then we saw what often hides behind such a move. Shorts caught off guard, leverage turning from tool to trap, margin rules forcing traders to buy back what they had confidently sold. At the same time, paper and physical markets started to pull apart. Futures ran one way, real bars and coins another, with premiums stretching wider, just as they did in past moments of stress. In 1980, in 2011, and in the early months of 2020, each split told the same story. The promises on screens were moving faster than the metal that had to be delivered. Layered on top of this, central banks are fighting inflation with words as much as actions, while everyday costs stay stubbornly high. Algorithms now sit between most buyers and sellers, ready to chase or flee in microseconds, turning single gaps into dangerous feedback loops. Taken together, the pattern is hard to ignore. Silver is not just reacting to one piece of news, it is signaling doubt about the system that prices it. The squeeze, whether short or long, is really about trust, in currencies, in collateral, and in the complex paper structures that claim to stand behind them. If history is any guide, today's move will not be the last sudden break in the chart. It may be the first clear warning that the next phase of financial stress will arrive through the places that were meant to be safe.